First hearing, obviously, post-Labor Day. A few financial decisions are more important than buying a home. Home buyers make an investment in themselves, their families, their communities. Home buying is essentially an act of optimism. It's also stressful. Families buying a new home have so much to think about, making sure they cover their down payment, navigating the mortgage and closing process, moving in, getting kids set up a new school if they have children. Buying homeowners insurance has always been a part of that process. It gives families certainty and peace of mind. Homeowners are confident their monthly insurance premiums will provide a backstop against the physical and financial devastation that could ensue if their largest investment is threatened by the increasing number of natural disasters, a tornado, hurricane, wildfire, other dangers or incidents or accidents. Knowing they're covered can help homeowners sleep better at night. Or that's how it's supposed to work. Increasingly, homeowners have faced an unpleasant surprise when it's time to renew their policies. Homeowners who spent years making their payments regularly without fail are shocked to find their insurer has raised costs, has limited coverage, or too many cases won't renew their policy at all. Insurers have abandoned, in some cases, entire markets, leaving consumers with fewer options that cost more and provide less coverage. Consumers are counting on their insurers now more than ever. According to NOAA, since the beginning of the year, the country's experienced 15 weather disasters, each resulting in losses of more than $1 billion. 15 weather disasters costing more than $1 billion. Swiss Re, a leading reinsurance provider, estimated that severe storms resulted in $34 billion with a B of insured losses in the first half of this year alone, the highest ever in a 6-month period. No reason to think those numbers won't keep going up with climate change. Hawaii, Florida, Vermont, extreme weather events upended millions of Americans' lives. Last month's horrific, deadly wildfires in our 50th state tragically killed at least 115 people, with hundreds more missing, projected losses of $6 billion. Losses from Hurricane Idalia, which plowed through Florida, Georgia, parts of the Carolinas last week, could reach $20 billion. Senators Welch and Sanders sent a letter to the ranking member, to Senator Scott and me, ahead of this hearing, detailing the losses Vermonters have suffered from devastating floods this summer. Higher insurance rates could hit the very homeowners, landlords, and renters who can least afford them, can hit them the hardest. So often it's the lowest income residents. We know that in disaster after disaster. It's the lowest income residents and communities of color have been pushed into the areas that are most vulnerable to natural disasters. As weather patterns continue to change because of climate change, risk and exposure will extend to places that have not previously been prone to natural catastrophes. This has led insurance companies to reevaluate risk concentration levels, and not just on the coast. As the head of the Association of Property Insurers said, there's no place to hide from these severe natural disasters. The result's been a disturbing and abrupt trend. Companies are restricting coverage or raising rates and deductibles. In some cases, they leave states or geographic areas out entirely. As Secretary Yellen recently noted, the result is a, quote, protection gap, increasing costs, limiting options for families, increasing financial stability concerns across the financial system. U.S. reinsurance rates, the cost of insurance that insurance companies buy to protect themselves by obviously spreading out risks, have reportedly increased up to 50%. These jumps in reinsurance premiums have been driven in part by frequent and more severe natural disasters for themselves, for their investors. Higher reinsurance rates mean higher costs for insurance companies, which then mean price hikes passed down to consumers every month, has left millions of Americans paying more for homeowner insurance, often with less protection than before, while others scramble to find any insurance at all because their insurance has refused to renew their policy. In California, most recently, 2 major insurers, State Farm and Allstate, stopped writing new home insurance policies in the whole state. Both cited the growing risk of catastrophe and spiking reinsurance rates as factors in their decisions. Not to be outdone, in Florida since 2020, 16 severe storms and hurricanes have caused more than $100 billion worth of damage and led to an exodus of insurers. Farmers Insurance became the 4th in Florida alone insurer to exit the market, joining Bankers Insurance, Centauri Insurance, Lexington Insurance, when announced in July it would stop writing property insurance policies in that state. 100,000 Floridians are looking for new coverage. Days later, AAA announced that it would not renew some high exposure policies in the state, despite the fact that average yearly homeowners insurance premium in Florida costs $6,000, the highest in the country. 14 insurance companies have either left the state or entered the receivership process. Insurers exiting state markets have left homeowners and businesses with no choice but to seek coverage from state-mandated insurers of last resort, which provide bare-bones policies at typically higher rates. Insurers of last resort are obviously exactly that. They're the last resort. That used to mean these insurers had a small share of policies, but as climate exposure has increased, as especially coastal states, but everywhere have been battered, insurers of last resort are growing. In Florida, for example, Florida Citizens, the state's insurer of last resort, is now the state's single largest property insurer, 1.4 million policies. California's insurer of last resort, the California Fair Plan, has seen more than 100% increase in policies in the last 5 years, reportedly offering coverage to 300,000 policies at the end of last year. It's not only homeowners hit by rising costs, shrinking coverage. The National Multifamily Housing Council reports similar issues for multifamily sector, higher rates and deductibles, coverage limitations, in some cases no viable private market insurance coverage option at all. And because each insurance policy is a contract between the property owner and the insurer, it's harder to know when insurers have stopped writing coverage for apartments in a community or a state. But apartment owners tell us they're seeing a clear trend. Renters will ultimately bear the burden as higher insurance costs are passed on to them in the form of even higher rents. Owners of our already too small supply of affordable apartments serving the lowest income renters may be increasingly left with impossible choices. Today's witnesses understand the unique challenges facing homeowners and property managers. Ms. Norris from Columbus, the capital of my home state of Ohio, is seeing the problem of rising insurance costs firsthand across the many states where National Church residences provide affordable homes for America's seniors. I'm pleased to have all three of you here today as we explore these important topics. Ranking Member Scott, welcome.
Thank you, Mr. Chairman. Thank you all for joining us today with such an important conversation about the state of insurance in the states around the country and the important role that insurance plays in the ability for a homeowner, specifically as we discussed today, to transfer the risk to an insurance company. As you would imagine, coming from South Carolina, thinking about my friends in Florida, in Georgia, in North Carolina, thinking about the devastation of the fires in Maui, my prayers and my thoughts are certainly with those folks who've lost family members who've seen their lives devastated, their properties destroyed. So much attention is given to the challenges of the environment, climate, but too often what we see, whether it's in Maui or in other states, is the man-made disaster that jeopardizes insurance in those states. I think about the fact that in my lifetime, as an adult, I spent, 20 plus years in the property and casualty insurance business. And so I do have an affinity for terms that we used when I was in business. And Mike, have you ever been in insurance?
Boy, have I.
Okay, good. So Mike also was an insurance agent and an agency owner as well. And one of the things that we would both talk about is the PML, the probable maximum loss. Can a insurance company calculate accurately, or even in the range of reality, what is a probable maximum loss within a market, whether that market is the Charleston area where we are prone to hurricanes, or whether it's the state of California or Ohio with storms and or other natural disasters. Can a company predict the loss that will be incurred, and can they absorb that loss based on the premiums they charge per policy? And when you cannot, you do not stay in a market. It is kind of that simple. Insurance companies have to follow the basic rules of economics like any other business, and that's one of the challenges that we see, particularly in states like California and Florida. California's over-regulated market makes it very difficult for insurance companies to make a profit in those states, and when you can't make a profit, you don't stay in those states. It's one of the reasons why you see, whether it's State Farm, AIG, the insurance companies that were just named, leaving markets is because the rate sufficiency is impossible to get there. and then the inability to find the path forward, whether it's the NFIP that provides some reduction of that risk, or, as I've discussed before, the absolute necessity of us to get our arms around the catastrophic occurrences from coast to coast, whether that's a hurricane, an earthquake, a flood, or tornadoes. We have not really wrestled with the actual damages done by catastrophic occurrences across the country. If you're on the coast, or frankly, if you're in the South, whether it's Louisiana, Florida, or South Carolina, we account for half of all the premiums going into the NFIP. But when a flood happens in New York or in New Jersey or in Ohio, the policyholders there never heard of or thought of a flood insurance policy. And so they're drawing money out of an account without having put any resources in that account. So we have some real challenges that we should identify and understand and appreciate that every insurance company is wrestling with today. But when you think about states like California and Florida, the two things without question comes to mind. One state, you have a burdensome marketplace that is oppressive, that drives business out. It's not just insurance companies that are fleeing the state of California. Every other business that can find another place to go seems to be looking for a different market. So I understand that. Florida, part of the challenge that we see in Florida is that the regulatory environment is challenging. Certainly the natural disasters are challenging, but with only 9% of the policies, homeowner policies in the country, they represent about 79% of homeowner insurance lawsuits. Over the last decade, companies in Florida have paid out $51 billion. However, 71% of that goes to attorney's fees. Something's broken in the market where it's not the homeowner that's receiving the lion's share of the resources, it's the lawyers, because of the challenges in a broken state as it relates to the litigious environment that is apparent, obvious, and clear in Florida. And so whether it's California or Florida, we need to understand holistically the challenges that these insurance companies face and why they continue to pull out the markets. I'd love to hear from the experts today solutions, opportunities to recalibrate markets, and for us to have a panoramic view of how to keep insurance companies viable in those markets. Because without any question, homeowners today are desperately looking for opportunities to afford the coverage. And I think the average, as the chairman suggested earlier, the average premium for a house, $1,700 for homeowners. For the same policy in Florida, it's $6,000. That's the case. It's not simply a case of rate sufficiency based on the probable maximum loss of a natural disaster. It has to do with the $51 billion paid to attorneys that have to be factored into that new definition of rate sufficiency that is going to be really hard to meet if that environment doesn't change.
Thanks, Senator Scott. I'll introduce today's witnesses. Doug Heller is the Director of Insurance of the Consumer Federation of America. He serves as a member of the Treasury Department's Federal Advisory Committee on Insurance, a member of the California Automobile Assigned Risk Plan Advisory Board, and a member of the Executive Committee of California's Coalition Against Insurance Fraud. Mr. Heller, welcome.
Thank you.
Michelle Norris is Executive Vice President, External Affairs and Strategic Partnerships at National Church Residences, the nation's largest provider of senior housing. She serves as chair of the board of directors for the Stewards of Affordable Housing for the Future, a member of the board of directors of the Corporation for Supportive Housing, and a past president and board member of the Sustainable Affordable Housing Management Association. Ms. Norris, welcome. Jerry Theodoro is the director of the Finance, Insurance, and Trade Policy Program at the R Street Institute. Prior to joining R Street, he served as director of insurance research at Conning and in multiple roles at Insure AIG. Mr. Theodoro, welcome. Mr. Heller, please begin. Thank you.
Good morning, Mr. Chairman, Senators. I am Doug Heller, Director of Insurance for Consumer Federation of America. There are several forces creating the property insurance crisis that has arrived in many parts of the country and is brewing in others. I will highlight what consumers are dealing with, the underlying drivers of the crisis, and some thoughts about how government, insurers, and property owners can work together to reduce costs improve coverage, and build safer homes and more resilient communities. In 2022, Americans spent about $125 billion for home insurance. It's rising about 40% faster than inflation since 2017. We hear from many around the country paying upwards of $500 per month just for their basic home insurance. Add more if they need to buy a separate flood, earthquake, or windstorm policy. Now, not surprisingly, regions exposed to the worst climate risk are being hit hard in this market, but this is a national problem. In fact, some of the highest home insurance prices are paid by residents of the Midwest who are facing tornado and hail risk. But the pain is not equally distributed. The neighborhoods most vulnerable to climate disasters are often home to communities of color and low-income Americans, amplifying the crisis for them. And it's not just geography targeting these communities. In all but a few states, insurers penalize homeowners if they don't have a great credit score, even if they've never filed a claim. This disproportionately harms lower income folks, people of color, and rural Americans, adding more pressure on the premiums that are already boiling over due to climate change. Now, the second part of the crisis is the insurance companies deciding to walk away from long-served communities and some states entirely. Since everyone with a mortgage is required to maintain coverage, and because people want protection for their most valuable asset, this is an incredibly scary situation. What makes people so angry, though, is that the insurers for years, who of course are the presumed experts on risk, they've told them that their neighborhood is fine and insurable. And of course, they always collected the premium. So for companies to just take their chips off the table without warning and walk away is unacceptable, especially after the industry resisted calls for climate risk analysis for years. As a result, we're seeing many more people forced into the state insurance providers of last resort, which sell a high-priced policy, often with bare-bones coverage. Or when people can't make their payments, they end up being force-placed into expensive coverage by their mortgage company. Or, and this we are hearing more and more, people simply cannot afford to own a home because they can't get insurance. Now, the third problem is the hollowing out of the coverage that people can afford. Rather than working in partnership with their policyholders and communities to reduce the risk of loss due to climate disasters, insurance companies are selling policies with less rebuilding benefit, more exclusions, and higher deductibles. Companies are reducing their own risk, sure, but that doesn't change the actual cost of disaster risk. It just transfers it back to homeowners, renters, farmers, and other consumers. So why is this happening? There are two key drivers of the crisis. First, the reality of worsening disasters is undeniable. Tackling this requires a collaborative effort to reduce the risk that stems from climate change by investing in safer homes and buildings and more well-defended and resilient communities. This involves better data collection, expanded public support of infrastructure investments, and more grants for individual homeowners and building owners to harden their homes. And when property owners invest in loss mitigation, they should be promised access to coverage and relief on their premiums. Also, this discussion must include issues of property development, affordable housing, and equity as we try to adapt to climate risk. If we don't take on those larger questions, then insurance companies will be the ones left in charge of land use and housing policy through their rate-making and underwriting decisions. Now, the second key driver of the current crisis is the exploding prices in the unregulated global reinsurance market, the ones that property insurance companies use to hedge their bets. Prices are up 35% since January alone, if insurers can even get that reinsurance that they seek. So we need a meaningful public-private partnership to address this massive market failure. The way forward is for the federal government to provide a catastrophe reinsurance backstop, just as we did with terrorism through TRIA, in exchange for insurers offering a meaningful insurance product, one without gaping holes and one that covers all major perils. In capping insurers' climate risk this way, the federal reinsurance program would provide needed certainty to insurers on, as Senator Scott mentioned, their probable maximum loss. So to conclude, by prioritizing their own exposure to climate change rather than on reducing the actual risk of loss, insurers have left American consumers in the bind that calls us to this hearing today. Effectively addressing these problems demands a holistic approach to climate risk and property insurability. It requires a focus on strategies that will reduce the damage done by climate change, strengthen communities, and use innovative public-private partnerships to create a competitive and sustainable insurance market that will yield affordable and quality property insurance coverage to Americans as we confront climate change together. I will, if we have opportunities during the questioning, I'd love to talk about Senator Scott's concerns about what's happening in California and Florida and make sure we address some of the details. But for now, I will just thank the committee for having me here And I'll conclude there.
Ms. Norris, welcome.
Mr. Chairman, Ranking Member Scott, and committee members, I would like to thank you for this opportunity to speak about the challenges in the property insurance market and how this is impacting the multifamily sector, especially affordable housing. For over 60 years, National Church Residences has provided housing and health care to older adults. We currently provide affordable rental homes for more than 20,000 low-income seniors in 23 states. My remarks largely today reflect those of a growing coalition of multifamily housing stakeholders concerned by the trends in the insurance industry and the impact they have on affordable rental housing and the people who live in those homes. I'm proud to be associated with several of those organizations, as currently mentioned, including Stewards of Affordable Housing for the Future, where I'm currently serving as board chair, National Affordable Housing Management Association, where I chair the Regulatory Affairs Committee, and the National Multifamily Housing Council, where we are a member. These groups, along with many other house trading associations, recently created a task force focused on finding solutions to the current insurance market challenges so that housing providers can meet long-term housing needs for our residents. It's with this lens that I would like to share what we know about the property insurance trends and the negative impact it's having on the housing supply and affordability. Property insurance rates in the U.S. have increased for 22 consecutive quarters. And in just the past 3 years, housing providers have reported annual premium increases ranging from 30% to 100% for affordable rental housing. In fact, at National Church Residences, we have seen our property and casualty insurance costs go 400% increase in 6 years. We are also seeing reduced coverage. Minimum deductibles on property-level policies have increased from $10,000 to $25,000 and up to $100,000, which is the option we had to take this year. In addition to the risk increase this presents, these high deductibles can conflict with financial requirements. To avoid defaulting on financing, housing providers have to take additional policies, create layered coverages, all which add cost. Even developers and owners with very large portfolios like ours have little bargaining power in today's industry. The pressures created by these increases impact our residents too. Increased insurance costs result in increased rents in market rate housing and in affordable housing communities. Continued rising costs may also lead to the reduction in services to our residents, deferred repairs, and threats to long-term sustainability of our communities. High insurance costs are also hindering solutions to the affordable housing crisis. Rising insurance costs mean lower net operating income to support debt or equity returns. If you can't borrow as much or attract less investment, it becomes even more difficult to finance the construction and preservation of the current affordable housing communities. We are seeing the volatility of the insurance market being driven by three key issues: the unprecedented frequency of natural disasters, the impact of inflation on replacement value methodology, and finally, on the insurance market capacity and policy limitations. Many insurers have simply ceased to underwrite multifamily casualty policies nationwide or in certain markets prone to natural disasters like the Gulf Coast states of Florida and Louisiana. I've detailed more information in my written testimony, but my message is this: we must act now. Our country has a shortage now of 7.3 million homes affordable to low-income people. We cannot afford to jeopardize existing rental housing or slow the creation of new ones. Both short-term and long-term policy solutions are needed. In the short term, HUD and other federal agencies can provide funding for affordable rental homes. They must rethink existing insurance requirements and provide increased flexibility and funding to property owners to account for the real-world challenges that we are facing. In the long term, investments in climate resilience, and the greater level of intervention by the federal government in the insurance markets are necessary given the current market failures. Thank you for the opportunity to speak today and for your efforts to explore and address these significant insurance challenges. We stand ready to work with you to further these efforts. Thank you.
Thank you, Ms. Doers. Mr. Thoreau, welcome.
Chairman Brown, Ranking Member Scott, members of the committee, thank you for holding today's hearing and for the invitation to testify. Today's hearing is timely. Consumers in states with ailing insurance markets struggle to secure homeowners insurance within budget. Availability and affordability concerns are particularly acute in California and Florida. Symptoms of the ailment include insurer insolvencies, insurers ceasing to do business or pausing new business, rising premiums, large natural disasters, Hillary, Idalia. First and foremost, it is a miracle that no lives were lost from Hillary or Idalia. Let us be grateful for that. California's and Florida's insurance markets are not all gloom and doom. Before we get to the good news, let's take the temperature of the broader market. Some maintain that insurance industry capital has been depleted. That's not so. In 2022, the primary insurance industry had a slight underwriting loss. For every $1 in premium that it took in, it paid out $1, 2 cents, and 7 mils in losses and expenses. Investment income offset the underwriting loss, contributing to a positive 4% return. According to economist Thomas Sowell, competition does a much more effective job than government at protecting consumers. The insurance industry, with over 2,600 insurers, is highly competitive. Chairman Brown, Ranking Member Scott, Ohio and South Carolina are among the most competitive states for insurance, especially South Carolina. It's number 4, so someone's doing something right there.
I agree.
States' residual markets are another window into insurance competitiveness. Residual markets are state-mandated insurers of last resort when insurance is unavailable in the standard market. California's and Florida's large residual markets are unhealthy symptoms. Insurance markets and loss exposures vary across states. Maine is the least catastrophe-prone, whereas California is exposed to earthquake, wildfire, mudslide, atmospheric rivers, even typhoons. One would expect property insurance premiums in California to be higher than in less catastrophe-prone states, but they're not. Homeowners insurance and premiums in Tennessee and South Dakota are about equivalent to California's, even though California's risk and building and repair costs are higher. California's insurance market troubles go back to Proposition 103 in 1988. Proposition 103 made California the only state to introduce public interveners who can challenge rate increase requests above 7%. This requires the regulator to address insurance rate change requests within 60 days. But the reality is that the 60-day rule must be waived before action is taken by the regulator, resulting in delays of a year or much more. This straitjacketing prevents insurers from charging risk-adjusted rates. The result is close to 20 insurers pausing new business or non-renewing policies. Proposition 103 is a form of price control. The academic literature finds that price controls do not work, and California demonstrates this. More ways the California insurance regulator handicaps insurers is by prohibiting insurers from factoring reinsurance costs and recent climate patterns into risk modeling. This is like forbidding a donut maker to change the price of its donuts, irrespective of flour and sugar costs. In contrast to California's price controls, Florida's market troubles were driven primarily by excessive litigation. As we've just heard, for years, Florida had the dubious distinction of being home to 79% of the homeowner insurance litigation in the country, despite having only 9% of the country's homeowner insurance policies. So what's the good news? In the spring, the California Assembly and Senate held productive, bipartisan information hearings on climate models. And in Florida, comprehensive tort reform was signed into law. What's more, several new companies with fresh capital have announced entering Florida, one just yesterday. Going forward, California's auspicious tailwinds of change should continue, and Florida should maintain its resolve and put its history of lawsuit abuse in the rearview mirror. On that happy note, thank you for holding today's hearing. Thank you for your consideration of my views. I look forward to your questions.
Thank you, Mr. Thunderberg. It's always good to end on a happy note. Thank you for that. Mr. Heller, you can't open a newspaper without seeing stories of homeowners facing skyrocketing insurance rates with less coverage, higher deductibles, not being able to find an insurer despite what some say. It's not happening, of course, only in California. Why are so many people across the country, answer this as short as you can, why are so many people across the country suddenly being priced out of the homeowners insurance market?
Well, thank you, Senator Brown. The first reason, I mean, there are a few reasons, but the first reason, and we have to acknowledge it up front, is that climate change is severely exacerbating the cost of risk transfer because it is increasing the severity and frequency of disasters. You mentioned an example, 15 $1 billion events this year alone. The Swiss Re actually reported that the most severe incidents were in Texas. You know, we talked about California, Florida. This is happening around the country. Climate change, as you said, is a national concern, and it's affecting insurance markets everywhere. The unregulated global reinsurance market is number 2, is a driver here. These drastically increased premiums over the past 2 years actually put the Rate Online Index produced by Marsh McLennan's Guy Carpenter subsidiary at the highest in the history of the index, which has been calculated since 1990. So that risk transfer is also too expensive. There has been inadequate oversight of state insurance markets around the country and some terrible rules that require some of the big state public insurers of last resort, the Citizens in Florida and Louisiana, to actually charge customers more than the actuarially indicated rate. That makes no sense. Why are we making last resort insurers charge more than they need to charge to provide coverage? And then finally, I mentioned there is the specific pain point for lower income Americans who, because they don't have great credit, find themselves seeing 40, 60, 80% premium spikes just because of that, even without claims. So it's a confluence of these incredibly difficult issues.
Thank you, Mr. I hope we can get agreement, at least acknowledgement from everybody on this committee of both parties of the existence of climate change and the severity and the huge cost in so many ways to all of us. Thank you. Ms. Norris, we've heard arguments that consumer protections at the state level lead insurers to stop writing homeowners insurance policy in certain states. The insurance multifamily property owners usually doesn't have the kinds of protections, as you know, and the oversight that a homeowner's insurance policy would. How is the coverage multifamily policies include different from the coverage a homeowner would buy, number one? And second, are you seeing fewer insurers offering multifamily coverage across the country?
Thank you, Senator Brown. Yes, we are seeing, first I'd like to highlight what was already mentioned about just the impact of climate change, to your point. As an example, national church residences, our 3 highest claims we've had in our history have happened in the last 2 years. One was from Hurricane Ida in August of 2021, $6.5 million for our organization. Hurricane Ian, which hit a single property in Florida and required us to vacate the property for 6 months and rebuild it at $13 million. And a winter storm, Elliott, which hit 44 of our communities. It's a really challenging time to be providing affordable housing. And so we see in the insurance market, our insurance is covered at a national level, so we work with carriers that go across state lines. But we are, in fact, seeing fewer and fewer options available for us. In fact, in our previous renewal, we had 4 carriers that worked with us on our property and casualty. 3 of those walked away and left us with a single carrier and basically a take or leave it on the premiums.
Thank you. Mr. Heller, I wanted to thank you for raising concerns around nonprofits having difficulty finding affordable property insurance coverage. I appreciated that in your testimony. I've long raised similar concerns, including at last year's insurance hearing. I'm hoping we can find a resolution to that. So thank you for that. Mr. Heller, you noted that raising insurance rates, reducing coverage, don't reduce risk. It reduces risk for the insurer and who shifted onto the homeowner. What can we do to actually reduce risk so that we can bring down costs and make homeowners and renters' properties safer?
Thank you, Mr. Chairman. There are really several things. I mean, we are doing, in some ways, a lot of this work with the Building Resilient Infrastructure Communities, the BRIC program at FEMA. There is some new data that was just released about where we need to invest most aggressively to provide the most return on those infrastructure investments around 500 different census tracts in the country. So we need to take the front end of the solution as serious as we've historically taken the back end by having FEMA emergency funds after a disaster. So that's what we really need to be doing, is putting our money up front. And I'll tell you one thing we have that could be done very simply. Senator Feinstein and Representative LaMalfa have bills that would make grants to homeowners tax-free for home hardening. And that's something we could easily do. I know in California the Earthquake Authority wants to be giving money out to people to strengthen their homes, but people are going to bear the tax burden of that, so that money isn't free, and it's not going to help them rebuild. So we need to make those investments on the front end. If we protect homes with $1, we don't have to rebuild with emergency funds with $5, $6, and $7 after the fact.
Thank you. My time's expired, but Ms. Norris, I want to just offer this committee's help on knowing it can be difficult for nonprofit operators to access resources for mitigation in ways that we can creatively work together. Senator Scott.
Thank you, Mr. Chairman. Mr. Theodoro, you said something earlier that I wanted to make sure I understood. If a company brings in $1 in premium but pays out $1.02 in losses, that's probably a bad thing.
That's right. That's right.
And so the only way that you make that up is by the ROI on your investment. Between the time that you bring it in, the time that you pay it out, you have an opportunity to invest those resources. If you invest them effectively in a good market, then you'll have enough to stay afloat. If you don't have that good market like today's market, where you have a 17% inflationary impact on companies and business, on gas, on all the supplies, it makes it more difficult to get that kind of ROI.
That's right, especially following the low and long period of interest rates when investment income was lower. So the contribution from investment income was depressed and did not contribute enough to bring the combined ratio below 100%.
Correct. Number two, repetitive losses. We just heard about rebuilding. National Flood Insurance Program, 1% of losses that occur are repetitive losses, but they account for about 30% of the payouts of the National Flood Insurance Program. So if you keep building in the same area where there is a disaster after disaster after disaster, the chances are pretty good you're going to pay more out.
That's right. That's why there need to be incentives for better behavior for the National Flood Insurance Program. Now they're trying to disincentivize these repetitive and severely repetitive loss properties by having a 25% increase if you have these repeated events. So send the right signals and people will respond by hardening, by taking preventive measures, by increasing resiliency.
Perhaps sometimes the federal government isn't really the answer to what local communities need to do in making decisions around whether or not to rebuild a property in a place where you've had multiple losses to the same property based on the same basic set of circumstances that come through a community.
That's right. The federal government hasn't had a good history of involvement in insurance. You mentioned the National Flood Insurance Program, which has bled billions, tens of billions of red ink. The crop insurance program also has these subsidies that don't encourage farming of the right crops and in the right areas. The insurance industry is, as you know, and Senator Rounds, is tremendously complex. Simple in principle, but in the execution, there's administration and policy issuance, distribution, actuarial, and a dozen other functions. And the federal government has no business trying to create insurance companies. It's simply not feasible.
Perhaps one of the reasons why we should all thank the good Lord for the McCarran-Ferguson Act of 1945 that made our form of insurance a state-based system of insurance. This structure has produced highly competitive, fair markets all across this country, and frankly, sets a global standard. Is that an accurate statement?
That's right. And efforts in the past that have followed strains in the insurance market to create a federal backstop or to provide government subsidized reinsurance have not been successful. They haven't taken off because it's simply not feasible. In 2007, a couple of years after Hurricane Katrina, KRW, Katrina Rita Wilma, Chris Dodd held a similar hearing, and chairman of the economic CEA, Ed Lazier, talked about the ways in which that wouldn't be feasible. Congressman Moskowitz, Charlie Crist, governor of Florida, and there was a Kevin Mahoney bill. A number of bills have been introduced sort of as knee-jerk reaction. Oh, the insurance industry is having strains. Let's send the federal government in to fix it. Doesn't have a history of working then, and it won't have one now.
Sounds like to me you've already answered my first question, which is about the fact that federal taxpayers subsidizing state insurance challenges is not a recipe for long-term success.
That's right. Subsidies and cross-subsidies, where the poor subsidize the rich, are both bad.
Simple, sounds like to me. Could you speak to why the insurance markets operate at a lag behind the rest of the economy and why we are seeing increased prices now? One of the questions I'm really trying to narrow in on is the important fact that over the last couple of years, we've seen an inflationary impact that we talked about that led to 12 rate increases. And so that new market where you have 5.25% or higher interest rates to be embedded into an insurance company's model, that costs something.
That's right, and it does take a couple of years before it earns in because, as we've seen with inflation, building material costs rose by 19% in 2021, 8% in 2022. Copper prices, other prices of lumber and metal that's needed in rebuilding homes have gone up, but it takes time because the loss may happen towards the end of the policy period, and then for the repairs are more expensive than before. So it takes 1 or 2 years before those inflationary impacts are fed in. So there's three main drivers of some of the strains: economic inflation, reinsurance cost, and natural catastrophes. I'm glad that you brought up the inflationary factor.
Appreciate it, sir.
Thanks, Senator Scott. Senator Reed of Rhode Island is recognized.
Thank you very much, Mr. Chairman. Mr. Hiller, if Congress does not act by September 30th, the National Flood Insurance Program does not exist. Can you tell us what the consequences of that will be? I mean, there's some, please.
Thank you, Senator. Yeah, I mean, Americans right now are facing these unprecedented catastrophes. We just saw Pennsylvania, New York, Vermont hit by severe flooding, and we need to have a flood insurance, and the private market has not been there to provide insurance for homeowners, and it's been stripped out of the homeowners' policies. And so we need a backstop so that there is flood insurance. I will say only 12% of Americans actually buy flood insurance. We are desperately uninsured or underinsured for this coverage. And I think it's important to note that Senator Scott is right, that the flood insurance program has not been a success. We need it there, because if we don't have it, then we've got nothing. But one of the reasons that a federal reinsurance program would be so valuable, like we did with TRIA when we had this desperate exposure, by bringing in a federal reinsurance, we could actually push the flood insurance product back into homeowners insurance, back into the state, back into the private markets, which is, I think, exactly what Senator Scott was calling for, because then the private insurers could be protected when they sell flood insurance, knowing that the worst case scenario was taken off, they were taken off the hook. But until we do that, until we push flood insurance out of the federal government and back into the homeowners policies that we all buy, we need to have a flood insurance program here in the federal government.
Well, thank you. There's also another approach, which would be mitigation. I know in my state, we're working with the Natural Resources Conservation Service, which is under the United States Department of Agriculture, and we're actually buying homes in areas that are flood prone, restoring floodplains so that there's a natural dissipation of flood waters, working with the Corps of Engineers. So my conclusion is we probably should do a lot more preemptive work with respect to resilience.
And Senator Reed, you're exactly right. I mean, that is our first, second, and third thing that we should be doing is reducing the risk. And we've got the knowledge and data. And whether it's with floods, as you're talking about, or with windstorms and fires, we know how important better roofing is. This stuff can be done, but we have to make the commitment to it rather than just shifting the decks on the the decks on the Titanic by saying, well, insurance companies aren't going to take that risk. Higher deductibles, less coverage. Homeowners, renters, and property owners, they take the risk instead.
There's a discussion, obviously, of the withdrawal of many insurance companies. In Rhode Island, our assembly passed a law that requires notification by an insurance company prior to their departure. And that gives the state the opportunity to work with the company to see if there are ways that you can diversify or do other things that could compensate. Is that an approach that is worth emulating elsewhere?
Yeah, I think that's exactly right. And what you're doing in Rhode Island makes a lot of sense. This is the thing that we hear from homeowners all the time. Why am I suddenly being told I can't be insured? They've always insured me. And the point is we need to have a transition process. Insurance companies can't take our money for decades and decades and then say, oh, now we realize there's climate change. We're out of here. So it's really important that you have a transition process like you're talking about.
Thank you very much. And thank you, Mr. Chairman.
Thanks, Senator Reed. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman, and thank you to all of you for coming before us today. Mr. Theodoro, I'm curious, how long have you studied or participated in the insurance market reviews?
I've been an analyst of the property casualty insurance industry for 15 years. 12 years at Conning, an insurance research and asset management firm in Hartford, and for the last 3 years leading the insurance research at R Street. Prior to that, I was in the industry. I worked in the industry as an underwriter and in other capacities.
Just curious, I was first licensed in the insurance. I was first licensed to sell insurance as an agent in South Dakota in 1978 for homeowners insurance, and carried that license all the way up until 2015 when I was elected to the United States Senate. Just curious, during that time period, you learn what's in a policy and what's not in a policy. And under a homeowner's policy, there was an old HO2 form, and it was transferred into an HO3 form where you had named perils, and then you had special all-risk coverage with exceptions built in. But I was trying to think back. I don't believe I've ever seen a homeowner's policy which was available with a flood insurance as part of the original perils. Are you aware of a flood insurance or a homeowner's policy that started out under the basic forms with flood insurance?
No. Flood has been excluded for several decades prior to the 1970s when you began. The HO3, which is the most common form, the
Special form,
is excludes flood. The flood insurance program, National Flood Insurance Program, has been the principal provider of flood insurance. The good news is that the private market is growing. I'm going to bring some good news in here. Now there's 77 private companies that are writing 31% of flood insurance business compared to 12.6% just a few years ago. So the private market is starting to come in, especially since the new rating methodology has been introduced.
I think also there's right now we have an NFIP, the National Flood Insurance Program, which is a backstop for flood insurance across the country. And I think it's very important that we get it renewed. I think it's an important aspect for a lot of areas, particularly where the risk is high. But the vast majority of Americans, they simply look at their policy and they say, I don't need flood insurance because I'm not in a flood insurance flood-prone or an area which is prone to flood, so they don't buy it, or their mortgagee does not require them to buy it. So what you end up with is in many cases, and the folks who would buy it are the people that think they may have a loss or are being required because the federal government believes they may be in a flood program or in a flood zone. Correct?
That's right. And that leads to two problems. One, you have adverse selection, which means that the policies that are written are the ones with the perceived highest risk. They're next to a river or a creek or on the coast. And you have low penetration. There's 70 million homes in the United States. Only 5 million carry flood insurance. And it's estimated that over 80% of homes in the United States are exposed to flood. As we've seen the last couple of years, we have these atmospheric rivers, these these rainstorms that are horrific and violent, that are removed from bodies of water. So the flood exposure is there, the market is underpenetrated, and there's adverse selection.
You know, we represented dozens of insurance companies that wrote homeowners in the agencies that I've had an ownership interest in South Dakota. I found them that they either wanted to be in the market and they wanted to be writing a lot of insurance coverages. They didn't want to write one or two, they wanted to write lots because they made a profit if they had a larger part of the market itself. The vast majority of insurance carriers would love to write for a particular line of coverage if they thought they could make a profit. Fair enough?
That's absolutely right. So the exodus from California is, as Ranking Member Scott said, law of economics. If you're losing money, there's no reason to go on doing that.
So in this particular case, if we recognize that there are certain areas around the country where carriers have simply said, look, we can't make a profit there, we're on our way out. Mitigating circumstances, climate change is part of it. Being able to appropriately increase your rates for the risk of some of those severe weather events. If they're not able to increase rates based upon that, then they simply look at it and say, we're a for-profit organization, we can't make a profit. But there seems to be a movement out there still where people think that we should spread that out to taxpayers to pick up those losses and keep the rates low. Is that a fair assessment of what some folks think is a better alternative?
Yeah, that would socialize the risk and penalize people unnecessarily and allow people that have got higher risk to go on having that higher risk.
Thank you. Thank you, Mr. Chairman.
Thanks, Senator Ron. Senator Menendez of New Jersey is recognized.
Thank you. Mr. Theodore, what happens, though, when the private market makes a amount for insurance that is almost unfeasible to be able for the homeowner to afford? They choose not to have property flooding insurance. And the consequences of that when we have the storms or the wildfires or the flooding that ends up the federal government comes in and helps the state. Isn't it better to have a system that is somewhat insured here?
The affordability, unaffordability issue can be dealt with means testing. If there's real unaffordability and there is home can't be moved or can't harden the home, then there can be some form of means testing. The good news is that with the new rating methodology, 20% of policies have seen a decrease in the premium that they have.
An enormous number of people have left the National Flood Insurance Program as a result of risk rating 2.0. Let me just ask this. Decades of inaction, particularly on climate change, is causing the property and casualty insurance market to buckle under competing pressures to provide returns for shareholders and sell a product, though, that policyholders can actually afford. As businesses, insurers have an obligation to their shareholders to make a profit. I get that. But as policymakers, we have an obligation to correct for market failures when there is a compelling public policy reason to do so. And here it's to ensure families can afford necessary coverage and prevent collapses in our local housing markets. Because between wildfires, droughts, and flooding, the reality is that there is nowhere left in the country that isn't being challenged by a natural disaster. Ms. Norris, in my state, you have senior communities in Brick and South River and Elizabeth, just to mention some, that are historically challenged with flooding. What would it mean, and by the way, those communities are not wealthy by any stretch of the imagination. What would it mean for costs for seniors if homeowners becomes in terms of flood insurance becomes unavailable and flood insurance becomes prohibitively expensive?
Thank you, Senator, for the question. And I assume you're talking about in our multifamily communities, our affordable housing communities that we have in your state, correct?
Yes.
So in New Jersey, along with all of our other communities and other states where we provide affordable housing, the idea of us as the owner being able to not be insured puts a tremendous risk not only on us but on our residents as well. At some point, if we were not able to get insurance, then it would leave our building and our residents completely exposed. We have, as I mentioned earlier, we've had our highest 3 claims have happened in the last 2 years. If we didn't have insurance, those apartments would have been completely unable to be reoccupied.
So people would be out.
Right. As a matter of fact, at one of our communities, they were out for 6 months while we rebuilt. Without insurance, we would not have rebuilt, and they would have been just left to find their own homes.
Well, it's senior communities like the ones that you're talking about are part of the reason why I introduced this bipartisan NFIP REACT. The legislation would ensure flood rates stay affordable while providing generational investments in mitigation and risk mapping to tackle long-term challenges of flooding. Nearly 11 years ago, we in New Jersey faced the worst natural disaster in our state's history. Superstorm Sandy destroyed homes, shuttered businesses, flooded entire communities. But in the months and years following Hurricane Sandy, New Jerseyans faced a man-made disaster in getting an honest claims check for their flood insurance policy. These are people who paid a lifetime, never made a claim, and all of a sudden, now when they're making a claim, through the manipulation of engineering reports and utilizing obscure loopholes, insurance companies acting as contractors for FEMA systematically lowballed policyholders. I subsequently led a charge for FEMA to establish the Sandy Claims Review, which resulted in $260 million more paid out to families that were previously denied. But it seems to me that an old dog doesn't seem to learn new tricks. Mr. Heller, what are you seeing in Florida for homeowners insurance policy holders in the aftermath of Ian?
Yeah, thanks, Senator. It's been terrible for so many homeowners after Ian. I mean, we've seen the evidence now of insurance companies that were literally changing their own adjusters' claims values. This is just a straight fraud from insurance companies, and we need to prosecute those fraudsters, those insurance companies that are cheating people. But how we're not learning that lesson, how regulators aren't coming in real time and taking the data to figure this out, is leaving homeowners exposed after they've paid their premiums for years, these escalating premiums, and then when they need the companies most, the companies turn their backs on them or even cheat them.
My legislation stops the bad actors from taking place, roots out what took place in Sandy so it doesn't happen in the nation. One final question, my name, Mr. Chairman. Mr. Heller, does the NFIP have a regulator that they have to submit rate changes to?
So the NFIP goes through its process, but what we've seen is we've seen sort of 2.0 with these massive rate increases for a lot of people. It's really quite frustrating. We need to be making sure that the rates that come out of NFIP are fair and distributed fairly. I do actually appreciate the idea of means testing to make affordable rates, but we have not seen an appropriate. We have seen real problems at the NFIP.
We've lost 150,000 policyholders, and by their own admission, FEMA says we will lose 1 million policyholders by the end of the decade due to the premium increases. That's not a way to solidify an insurance program. Thank you, Mr. Chairman.
Thanks, Mr. Menendez. Senator Tillis of North Carolina is recognized.
Thank you, Mr. Chairman. Seek unanimous consent to submit one opinion piece and one article related to some of the root causes of California and Florida's problems.
Without objection, so ordered.
One of those was actually co-authored by Mr. Theodorou. Mr. Theodorou, I want to go back to, I think, a very important number that Senator Scott touched on too. Said for every dollar of premium taken in, you paid out $1.02. Is that correct?
That's right.
Okay, so for the premiums that they judged were necessary to cover their risk, they were off by 2 cents on the dollar that year, right?
That's right.
And fortunately, they have a hedging strategy where they have investments that hopefully have a return to make up those losses. So would it be fair for anybody to say that the insurers who are paying out more than they're taking in premiums are making money hand over fist and greedy?
No,
I mean, based on the data?
The data says they're not. The 2022, there was a 4% margin, profit margin, because investment income kicked in about 600 basis points. And long term, the insurance industry has got a return of 6.5%. Companies that are publicly traded have about 14 to 15%.
Yep.
So the insurance industry has a much smaller margin than other industries.
So we're, I mean, a part of what we could be doing here is considering national policy that is trying to address some of the shortcomings that, in my opinion, exist as past policy that's been passed in states like California. You mentioned Prop 103. You took a look, they're addressing some of the problems in Florida through tort reform. I'm glad they got on board. We did that 10 years ago in North Carolina. But there seems to be a suggestion here that we just don't have enough regulations in place at the state or federal level to fix this problem. Do you actually think there are glaring gaps in additional regulatory measures that we should take to fix this problem?
No, I don't. I think that the push to establish some sort of, or to introduce some sort of federal backstop or support, however well-intentioned, would backfire because contrary to popular opinion, the reinsurance market and the primary insurance industry is not on its knees. It's not collapsing. It's in the business of dealing with catastrophes. There are cycles in the business. Inflation and interest rates are factors beyond its control. But in the mutual insurance industry, there's companies that have been doing business for 200 years. You can't be greedy for 200 years and not lose all your business. Mm-hmm. So they're doing something right, and they've been through storms before.
Do you think that there are many corporate boardrooms that have a strategy on shrinking their market size as a part of their growth strategy?
Only in states where they can't make a dollar.
Right. So the point is, why on earth would a major insurer exit California and Florida? Because they can't make the numbers work. They can't sustain it. And we know why. So I think a part of what we have to examine here, to the extent the federal government should get in, is examine the policy decisions made at the state level that are creating these structural problems that cause insurers to exit markets. I mean, I don't know how we actually get and address you listed off, Ms. Norris, 3 key areas that need to be addressed. We need to address all of them. I just don't think that we accomplish that through some sort of a centralized, more burdensome regulatory construct coming out of Washington. I think there is a way to fix this problem, and I don't think it's with a big federal government solution to the problem. I think it's working through the root causes and looking. I mean, you could draw a nexus between policy decisions made and why you've exited the market. I do like what you've said about affordability. Mr. Heller mentioned affordability. I think that we should find, we do have people who are seeking insurance that they'd prefer not to be on that property anymore. We fail with FEMA. We fail with resiliency measures. We fail with movement. I've got property owners. We've had 53 tropical cyclones impact North Carolina over the last 20 years. We average landfall of a major storm in North Carolina every 4 years. I've been dealing with this for the 16 years that I've been in elected office. But I don't believe that the mindset that some of my colleagues have here is that this can be fixed in Washington. It needs to be addressed on a state-by-state basis. We have to provide a backstop for flood insurance. We have to address these problems. But it's not going to come from compelling a private sector business to serve a market that cannot be sustained with all the constraints that they have on rating for the risk. I did have one final question, and Mr. Heller, I just want to confirm what you said, and then Ms. Theodoro, I'd like to get your opinion. You said that credit risk rating alone could increase a premium by as much as 80%?
Yes, sir. We see premiums actually jump for people with low credit but no claims history, low personal credit history, up by as much as 100%, sometimes doubling of their premium just because of their
Mr.
credit.
Theodoro, could you explain to me why you believe a part of the actuarial process should include a credit risk rating?
The credit score, insurance-adjusted credit score, has been found to be correlated with losses. The industry, though, I think, or from what I know and from my experience as an underwriter, doesn't overprice policies because of credit scores. If it did, competitive forces would come in and issue a policy.
If it wasn't relatively correlated to the risk, it wouldn't be a factor in the actuarial process. Mm-hmm. Okay, thank you. Thank you all for your testimony.
Thanks, Senator Tillis. Senator Fetterman of Pennsylvania is recognized.
Thank you, Mr. Chairman. Thank you very much, Mr. Chairman. Bye. Thank you. Mr. Heller, can you walk by me? Happens when in Pennsylvania a working family can't get insurance coverage.
Thank you, Senator Fetterman. Well, what happens is people can't have their home. I mean, they can't own their home, or if they're a renter, they don't have the protection they need if disaster strikes. They oftentimes don't have a place to go. They don't have coverage for loss of use if a building comes down. But what we're seeing for some people who can't make their premiums, homeowners who can't make their premiums, they're being actually force-placed into a policy by their mortgage company where their mortgage rate will go up, their monthly mortgage rate, to buy the coverage for the lender, but that actually provides no coverage for them. So we see people who can't afford their coverage ending up paying for the insurance for the mortgage company anyway, but they have no protection afterwards. So one way or the other, either you're uninsured and losing your home, or you're force-placed into a coverage that doesn't protect you, or you don't have the coverage as a renter for what you'll need when disaster strikes. And this is happening, and this has a financial downstream effect that, of course, is catastrophic for the individual families after disaster strikes, whether it's a home fire or a flood or a windstorm.
Is there ever a good reason to penalize new business buildings solely based on their zip code?
No, this is one of the problems. We have the history of redlining in America has been such a troubling one, and we see it in the home insurance market as we saw it in the home owners market dating back to the 1930s. And when we have people who build safe homes and safe buildings, wherever they are, we should give them the credit for that, give the insurance to them so that we can encourage that kind of production. We want to talk about getting away from dangerous risk zones, but when you say from high risk due to climate disasters, when people try to build in communities that because of zip code and redlining history can't get insurance, then we're giving people no options, especially for affordable housing. And it makes no sense to have this sort of high influence of zip codes on the home insurance price. Not nearly, it's just devastating.
Yeah. What is the financial benefit of proactive land use planning?
Well, it means lowering the cost of risk, and that means lowering the cost of insurance. It means safer homes and safer communities. Pennsylvania has done a lot of work in investing in that front end. Either we protect homes and communities before disaster strikes, or we're rebuilding with taxpayer costs afterwards. So the protection not only is good for the communities and families, it also means that the insurance companies have less risk to bear, which means they can charge lower premiums.
Okay, thank you. And I cede my balance back to the chair.
Thanks, Senator Fetterman. Senator Vance is recognized from Ohio.
Great. Thank you, Mr. Chair, and welcome to the folks testifying before the committee. We appreciate your time, especially want to have a welcome for Ms. Norris, a graduate of Miami University in my neck of the woods in the state of Ohio. So I appreciate you all being here. I want to focus on the California model and whether there's just something sort of fundamentally broken about the way that California regulates its insurance market. I mean, if you sort of step back, and we all agree that we want people to be able to afford home insurance, whatever their station of life and however much money they make, there are two sort of ways to do that. One is to help lower income people afford insurance in a market that is reasonably regulated and actually operates effectively. Another option is to try to regulate the market such that it can't actually function properly, and so it doesn't actually provide the benefits that insurance is supposed to provide. And I worry that California has gone down that pathway and that we're frankly learning, or we risk learning, the wrong lesson. So I want to direct my questions first to Mr. Theodoros. Thank you for being here. Theodorou?
That's right. Thank
Theodorou. Okay, sorry about that. Could you maybe just explain Prop 103, what it changed about insurance regulation in the state of California?
Sure. In 1988, Proposition 103, a ballot proposal was passed by a slim margin in California, and it gave a 20% rebate to automobile insurers. It introduced the intervenor process where parties could argue for rate decreases. It established a deemer provision, which indicated that the insurance department would respond within 60 days, something that hasn't happened. So those are the three main things, and prior approval of rates.
Yeah. And sort of, am I right that the regulatory regime that's sort of come out of Prop 103 is very backwards, folks? In other words, insurers are focused on accidental loss, casualty loss, and so forth that's happened in the past. That's what they use to set insurance rates, as opposed to forward modeling for future risk.
Yeah, those were two statutes that are introduced. One that prevents them from using the recent experience of catastrophes, the last 6 years. And there's another statute that prevents the use of incorporating reinsurance cost. Reinsurance is part of the cost of an insurance company. So those are two other provisions in the California statute, which are in addition to the Prop 103
Great. Thank you. Mr. Heller, I want to sort of direct this question to you, and it sounds like you want to say something. Feel free to do so long as we have the time. But one of the arguments I've heard is that the reason insurance rates are so high in California is because of the threat of climate change, which, of course, places that are closer to the oceans, theoretically, going to be more at risk to climate-related disasters. I guess my question here is, how can we credibly argue that climate risk is what's driving California's insurance market when they're more backwards looking than forward looking? Of course, the risk to climate change is in the future, not in the past. And second, you see all types of casualty insurance rates going up. So it's one thing to say property insurance goes up in response to climate risk. It's a little bit harder for me to swallow the idea that auto insurance would go up in response to climate risk. And yet that's exactly what we see in California.
Thank you, Senator Vance. And I'm a Californian. I've been working in California insurance market for over 25 years, so
Sure.
I appreciate the opportunity to focus in. I'd like to just start by just noting there's real misinformation here, because from 2019 to the present, California, and I really want you to hear this because it's very important, California has been one of the most profitable homeowners insurance markets in the nation, vastly more profitable than the country as a whole. So when we say that companies are leaving, that is, they're not leaving, they're kind of cutting back on their business. But it's not because they haven't been able to make the return that they've asked for. They have actually done better in California. And over the since 2021, they've received 95% of the rate increases they've requested in the regulatory system that does work, but also allows public input, and that's been so critical. So I just want to make sure we're on the table.
And is that profitability, Mr. Heller, because they've effectively left the riskiest markets and focused on the most profitable markets?
No, that's profitability because California has given them the rate they need, and California has invested over $2 billion in wildfire prevention. And we have done the work in California and used the regulatory protections for consumers to ensure that prices were escalating as they needed to be, but also maintaining the protections. And you mentioned, so I wanted to answer the other question you mentioned, which was this pass-through of reinsurance costs. Well, we've talked about the fact that reinsurance markets are right now escalating to the highest point they've been in over 30 years. And California does allow insurance companies, there is no statute, as Mr. Doro said, there's no statute that prevents them from buying reinsurance. They can't pass through the excess above what's actuarially indicated onto their consumers. Now, in states that do allow the pass-through, states like Florida, Louisiana, Colorado, the insurance premiums are much higher than California, but they're also seeing withdrawals from the market. They're also seeing companies underwriting out certain communities. The pass-through of reinsurance allows the insurance companies to be free from that exorbitant international unregulated market, but it does not protect consumers from withdrawals. That's happening everywhere, irrespective of this pass-through.
Mr. Chair, I know we're running low on time, but could you just address the climate question, specifically in relation to auto versus property insurance rates?
So, well, climate does impact auto to a degree on the obviously on the comprehensive policies, but that's only a portion.
Right?
Yeah. So, first of all, I disagree with the fundamental point you said about climate being a coastal issue. The derechos that are going through the Midwest are linked to climate change, and that's driving some of the highest rates. I mean, climate change is hitting everywhere, so I don't want to mistake this as a coastal issue around the country. It's really a national issue.
But I think we'd all agree,
insurance,
California is probably more at risk from climate disasters than the state of Ohio. And
that's,
as an Ohioan,
Ohio's a great place to be. Absolutely. The auto insurance market in California is not different than the auto insurance market we're seeing around the country. Now, the one thing is that auto insurance in California, because of the protections from Proposition 103, prevented insurance companies from getting as much of a windfall during the pandemic when we were all stuck at home not driving, whereas around the rest of the country, companies kept on charging as though it was 2019, even though we were all stuck at home. So now there has been inflationary pressures because of car repair costs that are independent. They're more driven by COVID, post-COVID, I think, than climate change. So we are seeing rate increases in California. But as the Washington Post just reported the other day, those rate increases are as severe around the country. It's not a California-specific thing, and it's by no means related to the regulatory oversight and consumer protections of the state.
Senator Vance.
Thanks, Mr. Heller.
Thank you. Time expires. Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So insurance is there for natural disasters like floods or fires or storms, But climate change means that natural disasters are hitting harder and more frequently than ever before. And that's upending the insurance market and pushing insurers out of entire cities or even entire states. Without insurance, millions of families will be at greater risk for climate crises. And as whole communities lose access to insurance, the impact is going to be felt all the way through our economy. So let's talk about what some of the tools are to make some changes here. More than 2 years ago, President Biden issued an executive order telling the Federal Insurance Office, FIO, whose job it is to monitor the insurance industry, to examine the impact of climate change on private insurance in the United States. So FIO proposed to collect new data from insurers that would help the federal government better understand climate-related financial risks and to assess the potential for major disruptions of private insurance coverage across the country. So, Mr. Heller, would the data that FIO is proposing to collect help identify the threats to consumers and the economy from climate change? Would these data be useful?
Yes. Thank you, Senator Warren. Of course they would. We really need to understand with granular data where the industry is more exposed, where coverage offerings are shrinking and consumers become more exposed, and how risk transfer has changed over time. Think growing deductibles, these lower rebuilding costs. The pressure to keep information from getting to the public and to public policymakers, not just through FIO, but for years that we've seen this needing data but not getting the data. I mean, it's one of the reasons that the market crisis we're talking about today kind of feels so sudden, because we haven't been collecting this data that would have given us the tools to prepare.
Okay, so I can tell I'm talking to another data nerd. We want to get the numbers because they are helpful in helping us understand and assess risk. So if the information is important, we need the information. The president has asked for the information. Why don't we have it? This has been more than 2 years now. It turns out that the insurers and the regulators, state regulators, are pushing back on this. They say that collecting this information is unnecessary. I'm just going to quote them here, ill-advised and burdensome. And they've claimed that this data call would threaten so-called existing efforts that insurers have made to mitigate the risks of climate change on policyholders. They're even saying that the FIO and the Biden administration is strong-arming insurers and regulators to adopt climate risk mitigating strategies, and this could lead to higher compliance costs on insurers and higher premiums on Americans. Now, it seems to me here that the insurers and the regulators are going out of their way to hide information about premiums, claims, profits, and coverage. And without that information, consumers have no way of knowing if a hiked premium is justified or if it's just padding an insurance company's profits. So, Mr. Heller, you explained why we need the data. Why are the insurance companies resisting so hard on providing these data? What are they trying to hide?
Well, the insurance companies don't want us as the public, but also public policymakers, to really understand where things stand, because it allows them to do what we've seen in California, which is try to bully regulators and policymakers by saying, oh, we're going to leave if you don't do exactly what we want. If you don't deregulate this market, we're just going to walk away from you. The reason FIO made this request for data was because there was a black hole where all the data needed to be, where we could actually figure this out for ourselves and understand. Is it, as some are suggesting, it's just a problem of regulatory burden? Or is it insurance companies that did not do the preparation that we've been calling for 20 years? Is it the insurance companies that have been shifting around their books of business to protect their profits and expose more consumers? And that data call would reveal it. And that's why the insurance companies have lobbied so hard to keep it out of our hands.
Well, I very much appreciate the notion, and I'm seeing nods here. I take it, Ms. Norris, that you would agree with this, that we need the data, and the data are essential both for making good policy and just evaluating what the insurance companies are up to.
Absolutely. We know that the insurance companies themselves have big data is out there. They're using big data to evaluate risk and decide what the premiums are. We should all be able to see the transparency.
All right. Well, I'm all for transparency in this. I appreciate the work that you're doing here. You know, this is just a reminder that the insurance companies have kind of been playing every part of this game. They've underwritten financing fossil fuels, and then they profit from selling protection from the impacts of those fossil fuels on climate. And now when climate risks are rising, they're trying to hang American families out to dry here and demanding either higher premiums or to get out of the market altogether. So there's a lot that's going on here that poses real risk to our economy. We need these data, and we need them now. Thank you. Thank you, Mr. Chairman.
Thank you, Senator Warren. Senator Kennedy of Louisiana is recognized.
Can we agree that the FEMA-administered National Flood Insurance Program risk rating 2.0 is woefully inadequate, Mr. Heller?
Yes.
Ms. Morris? Ma'am?
Yes.
Jerry, since I can't say your last name.
I would not say that it's woefully inadequate.
Okay. Imperfect as it is, does it make sense to you, Mr. Heller, to allow the National Flood Insurance Program to expire?
No, it doesn't. Short of getting a better solution in there, we need to have that backstop, and we absolutely should keep that around until we can.
We're not likely to get that better solution in a few weeks, are we?
No, we're not, but I'm glad that.
Do you think it makes sense, Ms. Norris, to allow it to expire?
I do not think it makes sense for it to expire. It needs to continue to be funded and reformed as needed.
All right. Mr. Jerry?
Thank you for the question. I think it should be allowed to continue, and not with a short-term 1-2 month kicking the can down the road.
Right.
I think there needs to be some more certainty about the availability of insurance. So I think a long-term reauthorization, 5 years, maybe 10 years, is more in order.
Right. Ms. Norris, if the world became carbon neutral by 2050, do you believe that would solve a lot of the problems of the costs of flood insurance and property casualty insurance?
Well, Senator, that's a pretty loaded question, and I'm not a scientist, but I do think, number one, that that's a wonderful thing to think about. I would love to know that we could get there.
Well, I've thought about it, and I'm hopefully you have too. But
I have thought
you
about
don't
it.
want to answer my question, Mr. Heller. What do you think?
It's not going to solve the property insurance crisis that we have now. It is part of the risk projection, as was discussed earlier. We're trying to make risk plans for years going into the future. So we have to begin to solve that problem.
All right.
In the meantime, but
You don't think it will solve the problem?
it's not going to solve today's problem. No, we need to take more.
All right. How about you, Mr. Jerry?
I think it's a solution to a different issue, to one of pollution and to emissions, and what are we going to do during the transition going from fossil fuels to renewables?
Okay. If you were king for a day, Mr. Jerry, tell me what you would do to fix the problem of the cost of property and casualty insurance today.
I would shine a spotlight on the areas where there's disruption and dislocation and
What does that
disequilibrium. It means to
Give me 3 specific things you would do, just top line, to fix the cost problem today, in English.
have the California legislature to repeal Proposition 103, to have Florida continue its tort reforms where it has eliminated the abuses from
All right, that's 2.
And the third one is to educate the public about how insurance works. I think that
Yeah, they know how it works. It's called write a check. And then you have to sell blood plasma to go to the grocery store, which you probably have to do anyway because of President Biden's inflation. Give me three things you would do, Mr. Heller.
Thank you. No shiny objects, as Mr. Jerry was talking about, Mr. Therodo. We need to be putting money into protecting homes, making sure the levees are strong, making sure the communities
Okay,
invest in
government
infrastructure.
subsidies, that's number one. Number
I
two,
would call it government alternative
Call
to
it
spending.
anything you want. It's
Alternative
taxpayer
to
money.
spending
What's number
emergency
two?
disasters. Number two is build a federal reinsurance program like TRIA. When businesses in America, when commercial sector was afraid they weren't going to be able to get terrorism insurance anymore because of 9/11, we came in and we've created a
Okay,
solution.
so the government gets into the reinsurance business. What's number three?
Let's get all of the regulators on the ball in the states. Move it down to the states. Get them on the ball to actually go through some of the data, because when we look at the data coming in from these insurance
Okay, that's
companies,
number three. Get the regulators on the ball. What's number four?
oh wow, I get 4. Thank you, Senator. Well, I think number 4 is to address for the needs of lower and moderate income people by making sure that we are not creating an insurance market that slices and dices and prices people based on their socioeconomic status with things like these credit penalizing good, safe homeowners
Let me give
with
Ms.
credit
Can I
penalties.
give Ms. Norris a chance, Mr. Chairman?
And then your time
Thank you.
expires when
Right.
she answers.
I'm sorry, Mr. Sherrod.
Without comments.
Mr. Sherrod, can I give, Mr. Sherrod said I can give you a chance to answer, Ms.
If I
Norris.
give you just two, first of all, I'm going to affirm everything that was just mentioned. Number one is we need to invest in ways of being able to get our communities and our buildings resilient.
Okay, government subsidies, that's number one. Number two.
And number two is to create this reinsurance program. We've got to stabilize the market.
Get the government in the reinsurance
Yes.
business.
Yes, and then I
Okay,
would say,
thank you.
yes.
Thank you, Senator John. Time has expired. Senator Van Hollen.
Thank you, Mr. Chairman. Thank all of you for your testimony, and I'll get to it, but I also want to raise some of the questions that Senator Kennedy raised. Ms. Norris, thank you for pointing out that seniors and low-income individuals are especially vulnerable here, and suggesting some proposals to address that, including, as we've discussed, mitigation and resilience. And I think you as well, Mr. Heller, have talked about that. But I think there's agreement here that the headline from the Washington Post just a few days ago sums up the problem. And the headline was, "Home insurers cut natural disasters from policies as climate risks grow." And then the first sentence is, "Some of the largest U.S. insurance companies say extreme weather has led them to end certain coverages, exclude natural disaster protections, and raise premiums." Everybody, all three of you, as I listen to your testimony, agree with that that's a problem.
Absolutely.
Okay. I understand, Mr. Theodoro, that you indicated that the price caps placed in California have exacerbated the problem. And clearly, there's some price point at which, insurance companies has to raise its premiums to cover the costs of damage. And if someone caps the price lower than that, they will exit the market. That's your point, right?
That's right. It's capped at 7%. That's another provision of Prop 103.
So if you remove the cap, I understand your argument. You have to choose really between them exiting the market or raising the premiums, right? So
that's right.
The alternative is to increase premiums on homeowners, including many low-income homeowners, right?
That's right. And also to encourage not building and living in the wildland-urban interface, where hasn't been mentioned, but there was a 39% increase in people building in the forests of California where they're exposed to the wildfires. Yeah. And Fort Myers in Florida has attracted, it's the 6th largest place for people to move to. It's got a lot. So it should have land use policy. Build smart. Don't build in areas where you're going to get hit.
Right. And as I listened to, I was listening to your all responses to Senator Kennedy's questions as to the answer, and a lot of the proposals, Mr. Heller, Ms. Norris, involve some form of government subsidy, whether for resilience, or I think, Mr. Heller, you've also proposed a TRIA-like approach or an NFIP type approach. Is that correct?
Well, yes, except I wouldn't say an NFIP approach. I would say the NFIP could be converted to a backstop, a reinsurance backstop. But if I could just quickly correct Mr. Theodoro, there are no price caps in California. That is just a falsehood that has been stated as a way to kind of create a fake boogeyman. Over the last 2 years, the average premium increase for homeowners insurance, unfortunately, the rate increases, has been 12.5%. He said 7%. There is no rate cap. It's just that the companies have to justify their rates to be accountable. That's a good consumer protection. So anyway, I wanted to correct that. But yeah.
So look, I'm all for collecting the data. I joined Senator Warren on her letter to collect the data. But as I listen to this, we all know we have a problem because we have climate change. It's increasing the extremity of the intensity and frequency of natural disasters. That obviously has a cost. And so the question, in my view, is who's actually going to pay the cost, right? And in my view, we should look to those who have actually generated the reasons for the damage here. I don't think taxpayers should have to pay for this. The market failure here is actually to price the cost of carbon emissions into the atmosphere that is heating up the atmosphere and causing these natural disasters. So I would just submit that rather than ask Mr. and Mrs. Taxpayer to have to be the ones who come forward, we adopt a proposal, which I've put forward and going to continue to pursue, to create what I call a polluter pays fund and ask the biggest emitters of greenhouse gases to help cover the costs of some of this, whether it's through a tree assist type system or some other system. What would you all think? That's a market-based solution. That deals with the externality that's not currently captured. If I could just get a response from each of you on that idea.
Well, Senator Van Hollen, of course, Consumer Federation of America would be supportive of that. We do, but let me just make a slightly nuanced point about that. The insurance companies, of course, continue to underwrite a lot of the fossil fuel producers in the country, and they use the investments, our premium dollars to invest in those fossil fuels and make a good return on it. And then, as they profit off of these factors that drive climate change, they downstream the external costs to the homeowners and property owners and nonprofits that have homes through our insurance premiums. So they make the profit on climate change on the front end with their investments, and then they downstream the costs of it to consumers in our premiums and our reduced coverage. So I think it's even more than that, but I would absolutely support there being a private sector source to cover these costs, so it doesn't just get flows down into individual families.
Well, yes, a private sector source based on those who
responsibility,
responsibility damages.
That's right,
Senator. I think it's a great idea. I guess I would also say that climate change, which has been coming and is now here, and we're all seeing it exacerbate. If we had started maybe a single solution 10 years ago, maybe we could have mitigated some of the issues that are here today. We need this and more issues, more solutions. So I would support that solution along with many of the other ones that have been brought to the table today. We have to act in many, many ways in order to fix what's currently here right now.
Thank you.
Yeah. I think the intention is noble, but it may miss the target because the largest emitters, the largest fossil fuel companies, drilling, exploring, refining, are outside of the ordinary property casualty insurance marketplace. They have captives. The largest oil and gas companies have got their own captives, their own inside insurance companies, which would be could be beyond the pale of regulators because they're not regulated the same way.
Right. Just to be clear, we would be essentially capturing the funds, fees based on those who are polluted, and they would have to defray the costs. It's a market-based solution. Thank you, Mr. Chairman.
Thanks, Senator Van Hollen. Senator Brett from Alabama is recognized.
Thank you, Mr. Chairman. I would like to start by reiterating the importance of preserving our state-based system of insurance regulation, a system that has effectively protected consumers for over a century. I am concerned, however, that the recent actions of this administration risk undermining the very premise of the system. Rather than leveraging the expertise of state insurance regulators, Treasury and FIO are acting unilaterally to push this administration's climate agenda, including by requesting a plethora of highly detailed climate information from insurers. Not only has Treasury been unclear with how they intend to use this data that they collect, but the effort would be duplicative in many ways, as many states and the NAIC already collect similar data to help them understand the economic impact of natural disasters and weather events. Any efforts from Treasury or FIO to sidestep state insurance regulators blatantly undermines congressional intent. FIO should work with and not around state insurance officials that have decades of experience assessing the market impacts of these catastrophic weather events. In this regard, we have had an active hurricane season last year and have already seen a number of named hurricanes in 2023. The frequency of such weather events has inevitably impacted the property insurance market. Insurance premiums, like all prices, are market signals to consumers, and the property insurance space, the higher the insurance premium, indicates the existence of higher risk. As someone who lost my house and my cars and my things in a storm, I get it, and I get the importance of it. I also come from a state that is ravaged by storms, whether they be tornadoes or hurricanes alike. So I understand the importance of getting this right. In response to higher insurance premiums, states like California have implemented overly restrictive regulations, including price controls on insurers. In essence, this deprives homeowners of market signals that could steer them towards building in better, less dangerous places or encourage them to build more disaster-resistant homes. So I want to get your thoughts on that statement. Is it Theodoro or Theodoru?
Theodoru, you said it right.
Okay, Theodoru. I'm going to do my best to get that right. Can you tell me, do you agree with that?
Yes, I do 100%. I agree that the efforts to get more data on insurance companies on catastrophes and their exposure is superfluous. Data is there. There's data at NOAA and from reinsurance companies that look at natural catastrophes, looking at frequency and severity at R Street Institute, because there was disagreement about whether there is increasing severity and frequency. We've been studying this in a publication that should come out in a few months. And also the FIO, the Federal Insurance Office, if we look at its remit, what is it statutorily supposed to do? To monitor the insurance industry, not to direct or to manage or to insert itself. In many ways, it's an agency without a mission. It was created as part of Dodd-Frank when people thought that the insurance industry was responsible for the global financial crisis, which it was not. So the federal efforts that have been introduced, however well-intentioned, have not been successful. If we look at the financials of the NFIP or the crop insurance program, and the way that the efforts to launch federally backed reinsurance backstops have failed, going back to Hurricane Andrew of 1992, let's not repeat the mistakes of the past.
Absolutely. And I only have a little bit of time left, so I'm going to transition into bragging on my state. We have heard a number of questions asked and a number of different solutions. I want to tell you somewhere where I believe Alabama has gotten it right. We have seen firsthand what effective regulation and active resiliency efforts look like. For instance, in Alabama, we have had a state grant program that incentivizes homeowners to fortify their roofs to withstand severe weather. The program was in response to damage ensued by Hurricanes Ivan in 2004 and Katrina in 2005. It was created to incentivize investments in more resilient homes and to encourage insurers to continuing issuing policies in these storm-prone communities with the goal of reducing future hurricane damage. When Hurricane Sally hit in Alabama in 2020, I am proud to say that the nearly 16,000 homes and buildings with fortified roofs remained intact. This resulted in lower insurance claims with less debris cleanup and allowed the community to reopen and to recover more swiftly. This is what effective action looks like, where state officials assess an event, identify a solution, and put into practice without regulatory overreach, something that works. Additionally, just last week, due to the great work of Governor Kay Ivey, Commissioner Mark Fowler, and Director Jeff Smitherman, the new Alabama Resilience Council met for the first time. The council will focus on public-private collaborations to help build stronger, safer, more resilient communities. This is just another great example of effective state-driven solutions. And I'm out of time, but certainly appreciate any comments you have on the great work that Alabama's doing.
It's my understanding that Louisiana has copied the program, which is a good thing, but I would say that it doesn't have to be government that provides this funding. I'm a homeowner. I replaced the roof on my house. I called my insurance agent, and I got a credit on my insurance. Doing the right behavior leads to lower losses, leads to lower premium.
Mr. Heller, be very brief.
Just very briefly, in my written testimony, I pointed out the Fortified program in Alabama. This is a model where government can partner with communities. And I agree with Jerry, unfortunately, not enough insurance companies are incentivizing by giving people discounts or making policies available when they do invest in their homes. So I think that this is a very important piece of the effort, which is why we've focused so much on front-end work, like is being done in Alabama, rather than trying to clean up after the disaster with FEMA money, when we could be doing it with insurance money and better resilient homes.
Thank you, Mr.
Thank you,
Moore.
Senator Brett. Senator Cortez Masto of Nevada is right.
Thank you. Let me follow up on the conversation, because as somebody who worked closely with our state division of insurance, I absolutely believe the states have incredible data that should be utilized as well. And then, Mr. Heller, let me touch on this as well. You noted also that Nevada regulators offer expedited review for insurers who submit filings to add discounts for homeowners who take mitigation measures. So let me just start there. What are some of the ways we can encourage insurers to incorporate mitigation incentives when they set the premiums?
Well, thank you, Senator Cortez Masto. This is an incredibly important thing, and we're very appreciative. We've worked with the Nevada Division of Insurance on exactly this, by laying out really clear discounts to homeowners that insurance companies should be providing based on the science that's out there. And we have the Insurance Institute for Building and Home Safety doing a lot of great work on this front, and groups like my colleagues at United Policyholders. We know that when you build stronger roofs, when you clear brush, when you take these actions, you can reduce the risk, and that reduces premiums. Unfortunately, too many companies have not followed through on giving those discounts, but many are, and more in California, they're required to, so that's being built into it. In Nevada, there are these incentives, and states should be looking at Nevada and California departments of insurance and looking at what's being done in Alabama. Because when we make ourselves safer, we reduce the risk, we reduce the cost. And so this is the kind of work that we should be focusing on right now, rather than some of the conversations about throwing away consumer protections.
Yeah, no, I appreciate that. In Nevada, we've seen rains and recently extreme weather absolutely happening. You see it across the state of Nevada because of that rains and flooding that has been devastating to some structures there, particularly in southern Nevada. I know Nevada has worked hard to build defensible space for its communities. I will say the U.S. Army Corps of Engineers has helped us in certain areas of the state. There are great partnerships that can happen, but I do agree there needs to be more opportunities and incentives to lower those premium costs, the work that homeowners do. Mr. Heller, let me, while I have you, talk about manufactured housing. In your written testimony, you note that people who live in manufactured homes pay more for lower quality homeowners insurance. Can you explain how insurance policies seem to fail some of the 20 million people who live in manufactured homes?
Yes, thank you, Senator. That is one of the more disastrous little segments of the market. And of course, it hits lower income homeowners and also older homeowners quite a bit. So these policies that are written for the manufactured homes are generally now all what's called the actual cash value. So they depreciate the value of the home when you need to file a claim, so you don't actually get everything you need to fully rebuild. They have weird exclusions. For example, the HVAC systems in those homes, they're considered contents, which has less coverage than what we see in normal homeowners policies, in which they're part of the home for rebuilding, so it's harder to do that. And then for some people, if you can't even get you can't collect your full claim if you don't rebuild in the same place. Well, if your home park doesn't reopen, you can't rebuild in the same place, so you don't even get to use the policy that you've been paying for. And yet, these manufactured home policies, which the market is even less competitive than the regular homeowners market, are more expensive on a per dollar basis, and sometimes just more expensive altogether than homeowners. So it's a really tough market to be somebody who's living in a manufactured mobile home and trying to get their coverage.
Particularly at a time when really manufactured homes are different than the manufactured homes of the past, correct? And there are more people that should be taking advantage of the lower costs for manufactured homes that put a roof over your head, but still provide you a level of comfort and security.
Yeah, in a way, the insurance industry is trying to ensure homes from decades ago, and we've actually done a really good job of making more affordable housing through manufactured homes, and yet the insurance products are substandard for people who either because they want to or because it's really all they can afford are in these communities and in these types of homes. And we need to do a better job to make the insurance coverage better. And regulators need to pay attention to these forms because they're not good enough.
Mm-hmm. Thank you. So, Ms. Norris, let me talk to you and stay on the affordable housing piece because our nation desperately needs affordable housing. Nevada is no different, and it's something I've been working on in the state. I appreciate your testimony telling us that rising insurance costs undermine not just the future of affordable properties, but those that currently provide homes to people. Can you expand on your statement that affordable housing providers may be forced out of the affordable housing market because of insurance and operating costs outpace allowable or even feasible rents?
Yes, thank you for that question, Senator. Yes, the affordable housing community runs on, it's a regulated world, right? No matter, there's a lot of different programs of affordability, but they all run on some basic principles. Number one is the people that move into our communities are people who need to move into our communities. They can't make too much money. So that's rule one. And rule two is we can't charge them too much money to live there. So that's basically the two rules of affordable housing. And so essentially, whenever you have a serious situation like this, with these catastrophic increases of expenses that rise quickly, there is no way to do an adjustment of the rents, nor do we necessarily want to. We don't want to just do a dramatic increase in rents for folks that can't afford it. But what that leaves us with is a situation where our expenses are crushing our operational margin or even our ability to meet our costs. That's a real problem because the regulators often, for example, with HUD, we can go and ask them for a rent increase. But if an insurance premium, which hits in the middle of a year, and we've already got our rent increase, we can't ask for another rent increase. And then if we ask it the next year, it may take them a while, actually a significant amount of time, to actually approve that rent increase. So we're set in a position where those rents can't possibly meet the expenses. That forces us as an owner to make really bad decisions. We have to either stop doing certain services, we have to defer expenses, any expense we can. And eventually it could end up saying, we just can't afford to do this. Mm-hmm. It could put those properties at risk, which can put at risk people's homes, and that's like 100 people at a time or 200 people at a time. So the impact on affordable housing is significant, especially compared to even the market. Does that help?
Thank you. And I know my time is up.
Thank you, Senator
Cortez
Masto. 1 minute.
Even less than
30
that,
seconds.
Senator. Okay. I just wanted to add on to one point because it's something you brought up at the beginning of this hearing, Senator. Nonprofit organizations are having a lot of trouble in the property insurance market, as Michelle has described, and you've been working on making the risk retention groups available to nonprofits. These are alternative mechanisms for insurance, and I think that that's just something that we should be making sure we add into the mix here because it really is an opportunity to have a private market solution that will help avoid the chaos that we're seeing for nonprofit housing developers as well as other nonprofits.
And I want to thank him for sharing on my behalf.
Sure. Thank you. Thank you to the three witnesses today for being here and providing testimony. Senators who wish to submit questions, those questions are due 1 week from today, Thursday, September 14th. To the three of you, you have 45 days to respond to any questions. Thank you for that. One other thanks to Jordan Harris, who will be leaving at the end of the week to take a job working on equity issues. Congratulations for that. The hearing's adjourned.